All right, welcome everyone. Greetings. I'm super excited about the interview today. Today I've got Karam with Software Equity Group, and we're going to be talking about SaaS valuations. But before we dive into the questions, Karam, can you tell us a little bit about yourself and Software Equity Group?
Yeah, absolutely. Hi, everybody. My name is Karam. I'm a senior associate here at SEG. I've been with the firm for about almost 6 years now. Software Equity Group is a sell-side M&A boutique firm. We're based out of San Diego. We work strictly with B2B software businesses that are looking for either a majority recap or a full sale. And I'm really excited to be here, Ben. Thank you very much for this opportunity.
Yeah, you bet. Yeah, and I'm excited about these questions. So, I work with a lot of SaaS founders in the B2B space, a lot of coaching, fractional clients, and valuation comes up, of course, a lot because either they're fundraising or they're looking for an exit. And, there's just a lot of info on the internet, but sometimes it's like, hey, where do we get started here? So I've got a bunch of questions here we'll dive into. But the first I think is really interesting is there a myth that strategic buyers will pay more than financial buyers?
Yeah, that's a great question. It is not a myth. Typically, strategics will pay a higher multiple than private equity firms simply because of synergies and differentiation. That being said, I would say most recently, we've started to see private equity firms become more competitive than they've ever been. And really, it's because at the end of the day, their mandate is to spend their dry powder on the companies that obviously they see an opportunity to grow and scale. And so with companies that check all their boxes, that are a scarce asset in an attractive market, ones that they can build a M&A and organic growth thesis around it, they can get competitive. But no, I don't think it's a myth.
Yeah, that's really interesting because I think, that, you think strategic buyers, right? They have maybe other opportunities to try to justify that valuation price, cross-selling, cross-pollinating products and customers where PE financial sponsors have to stay, disciplined with their investment thesis. But really interesting to see, that maybe is, taking place where strategics maybe have a little bit, paying a little bit more, but now the market's getting so competitive that maybe now PE has to catch up. So really interesting.
Yeah,
And,
I agree.
and then, one thing, valuations, right? We can value off of a multiple of ARR, we can value off of a multiple of Ebitda. And sometimes, I've seen in forums where I think people are getting backwards, like where should they start the size of the business and should they looking at a multiple of ARR or a multiple of Ebitda. So when does it make sense to use one or the other?
Yeah, and that's a good question. I mean, no company is exactly the same as the other, but generally speaking, it really depends on where the company is in its maturity life cycle, right? In the earlier stages, companies are typically focused on growth and reinvestment into the business. So they're not really focused on EBITDA and profitability, right? They're just trying to grow top line. And so focusing on ARR and ARR multiples makes a lot of sense. Versus when a company is much larger, further along in their maturity life cycle, kind of growth will still be there, obviously, but it will slow down just given the scale of the business. And generally, companies are starting to generate cash. They're more profitable now than they were maybe 5 or 6 years prior. And maybe in that scenario, it would make more sense to look at profitability or EBITDA versus ARR, but it really depends on the company profile and where they are in their maturity life cycle.
Yeah, interesting. So it sounds like early growth, early stage, you're growing hyper fast, you're reinvesting profits. So maybe multiple of ARR makes sense. But as you scale, say now you're acquiring companies and you're growing nicely, but then right, you have to reach profitability at some point, and then maybe EBITDA makes sense. Now, when we were talking before, you had a really interesting comment about TAM. How does TAM fit into, say, the valuations? Can it increase or decrease those common multiples that we see?
Yeah, and so that's where I wish it was black and white, right? Where the company is in the life cycle, it's obviously more than that. So if a company is earlier on, they're growing like crazy, but they're playing in a very small market. Their total addressable market is pretty small. That will cause, even if you're still looking at an ARR multiple, a slight or somewhat of a discount, right? Because you can continue growing that at that rate, but for how long are you going to tap out your market? You're going to start thinking of maybe different products or expanding into other markets or whatever it may be, to sustain that growth. And so at the surface, growth rate is phenomenal, and focusing on growth is great, but looking also more macro, what market, what's my total addressable market, that also plays a huge factor in terms of evaluating a company.
Yeah, absolutely. So it sounds like, hey, I'm growing, but can that sustain itself? Am I going after a huge TAM and it's the right TAM, or is it just that smaller TAM where eventually I'll tap out? So really interesting where like the TAM overlay onto top of multiples can either maybe boost it a bit or maybe decrease those multiples, it sounds like. So yeah, interesting. So next, I think of, multiples like, they're the end result of due diligence. It's kind of the chicken or the egg concept, working with founders. It's like, hey, I should be getting a 10x of my ARR. Or no, really, it should be a 12x, but aren't, and this is what I kind of think to myself, aren't multiples really the end result of all that due diligence and financial analysis where you come up with a valuation, right? And then that's how multiples have been created. So it's kind of a chicken or egg concept. What are your thoughts on that?
Yeah, no, I 100% agree. It's kind of the end result. Obviously, biggest driver of multiples are metrics of the business. Looking at growth rates, looking at retention, diving deeper into gross profit, looking at unit economics for the business, segmenting it versus on customer basis or per product, depending on the offering. Just looking at those dynamics, that really all comes together to kind of give you a valuation for the business. And then additionally, then you start looking at macro level, like I mentioned, total addressable market, look at differentiation. One of the most important things is product differentiation, right? We're living in a world where there's tools in whatever market you're looking at almost everywhere. So how do I differentiate? Why is my business worth X much versus somebody else's? If all else is equal, it's differentiation, for example. And so it's more than just, it starts with the metrics. That's definitely the heart of it. But there's obviously more to it as well.
So really interesting, right? We have the quantitative aspects, so metrics, but then, want to dig into this again is the qualitative. So you mentioned product differentiation, your competitive advantage, and not to pick on CRM systems out there, right? But hundreds of CRM systems. So you're saying like, are you another, just another CRM system, or how are you different, right, from all those others? Where actually, if you're just another CRM system, right, if you're looking for that nice multiple, right, again, it sounds like it could be depressed because you can't differentiate yourself among the crowd.
Right. No, I totally agree. And it's just, how are you going to sustain that growth, right? If your product is not differentiated, then how are you going to sustain growing at that rate and winning new businesses or new customers versus why aren't they going to go to others? So yeah, I agree.
And then you also mentioned when we were talking IP, right? So looking, investors coming in, right? IP is huge, that we own our IP, we've documented it well, and going through exit processes where it's like making sure contractors and employees, it's like we don't have any leakage or any issues in that IP area. So can you tell me a little bit about how, you guys kind of view IP, how investors view IP in that area? Is it like, does it make things, more difficult, risky, or, ambiguous?
Yeah, no, that's an important one. IP ownership is very critical for buyers. Obviously, when you're selling your business, the buyer needs to know, are you selling something you own, or what's, because if you don't, then it's risky, and with risk comes lower multiples, right? Nobody wants to take on risk, and so yeah, IP ownership is very critical as well.
Okay. And then, so now, nowadays, you're seeing a lot of people, a lot of founders building off other platforms. Say you've got an app exchange, tons of app exchanges out there, or like you've got ServiceNow growing really fast, building on these other platforms. Do investors see that as just the same, or are they going to take a little different approach or a little bit more due diligence if you're building on some other platform that could create, potential risk down the road that you just, you don't own, maybe, your own destiny because you're building off a platform.
Yeah, no, they will do more due diligence, and it could most likely what we've seen typically is that it would result in some sort of a discount, just because it just begs the question of dependency.
Hmm.
What if it goes away? Is your development kind of relying on somebody else's resources or whatnot? And so it does raise the question of additional due diligence and risk, and typically, like I mentioned, risk just unfortunately comes with some sort of discount.
So it's how, so there's a theme here that yes, if there's risk or perceived risk, or you cannot kind of box that risk or quantify it, that's going to cause maybe some valuation trouble
Right,
or some due
right.
diligence issues.
Yeah, you would definitely have to go out of your way to make sure that the buyer is comfortable with this risk and doing
Mm.
additional work to get them comfortable. Although you could originally be just comfortable yourself, but
Hmm.
at that point, that's important. But it's you also need to get the buyer comfortable.
Yeah, that makes sense, right? That transparency around the business. So,
Right.
we talked about chicken or egg concept, with multiples, we talked about, hey, the quantitative aspect, and you see this ton and, content on the internet. It's like, hey, this drives valuation, this drives valuation. So in your experience, right, you've got hands-on experience, in M&A, what metrics are really important? And I hate to say like drive valuation, have that direct correlation, but what are you seeing as far as metrics that founders and finance teams should be aware of that are, really correlated, driving valuation that are important in the valuation process?
Yeah, and they are very important. I mean, real quick, circling back on my comment about earlier, the myth, it's not a
Hmm.
myth. PEs will get competitive if a company checks all their boxes. And so some of those boxes are metrics, are growth rates, so are retention metrics, both gross and net retention. There are unit economics in a sense, right? Diving into the sales aspect of it. And so all those metrics are very important to track, especially if you're able to track it on per segment, whether it's a customer segment, whether it's a module, a product, whatever it might apply for that business. Obviously, every business is different. Tracking those is very important because those are the questions buyers are going to ask, PEs are going to ask for. And that's how, even before you get to a multiple, if growth doesn't exist, if retention isn't that good, you're not even going to get that far along, right?
Yeah.
With most private equity firms to even have a conversation, because
Hmm.
growth and retention are very critical when it comes to buyers' eyes, for sure.
Absolutely. So to summarize, we have growth rates, right? Which used to be kind of the king of valuation. Now it seems like, and you're seeing content out there where people are doing some analysis where now net dollar retention is maybe surpassing growth or just as important with, growth
Mhm.
as a valuation driver, as everyone's digging into public S1 filings to see, hey, what's net dollar retention?
Yeah.
So it sounds like retention, gross dollar retention. And then, what about the overall financial profile? What about, say, gross, margins, margins by revenue stream, EBITDA margins? What are your thoughts around those, as further things that they're going to look at and assess?
Yeah, I would say gross profit margin is very important, especially in our world of software, right? And so tracking it both overall and just simply recurring off of the recurring revenue is very, very important. And so that's something that should be tracked. What's also important for some private equity firms or some buyers, but not all, I would say, is EBITDA.
Hmm.
Some that's where you get in the details of what their investment criteria is for
Yeah.
some. break even or close to break even is fine. For some, it's a minimum of X dollars of EBITDA. And so that's important too. But like I said, that goes back to where is the company in their maturity life cycle. You can't typically expect company that's just started to be profitable and growing like crazy, obviously.
Yeah. And so it sounds like, so if you're going to look at an exit process here, you're a founder, you're the executive team, the finance team, it sounds like understanding your growth rates, understanding your retention, both in the form of gross dollar retention, that revenue retention, what's your gross margin profile, profitability, if that comes into play, EBITDA margins, and then say unit economics, for example, LTV to CAC paybacks. Yeah, you need to understand, and often, working with founders, I tell them, it's like, hey, what's that financial profile that you're going to hang your hat on, right? And do you see, and just maybe to help the founders out there, it's like, can you be good at all these things? Or is it okay to be like, hey, I'm good at 75% of these, but yeah, I do have some weaknesses, and that's okay.
Yeah, it's definitely the latter. I mean, no business is a perfect business, right? And it's definitely not the expectation at the earlier stages, right? And so, no, I would say, I mean, what's really important to focus on and track is definitely growth, as well as retention. So looking at customers' health, looking at retention rates, those are very critical. And then it would be very nice if you're able to track, obviously, your gross profit, the unit economics, because it all kind of gives you as a CEO or a founder a full picture of how is the business truly operating, where are areas that I need help. And sometimes as a bootstrap business, that's when you kind of need that partner with capital in order to work on these weaknesses. And so it's really more so acknowledging strengths and weaknesses versus just having all strength.
Yep. Yeah, absolutely. And I'm always telling founders, it's like, hey, you can't look at metrics in isolation, right? You have to look at that full picture, and what's that story? Is it telling the same story, right? And what to work on, what to focus on. So that makes sense. So thinking about exit, so say founders want to exit, what do they need to think about to kind of get their house in order? If they're thinking about an exit process, what are you working with them on to, like, help them prepare? Or do you see like pain points, that they have to work through first before they go through an exit process?
Yeah, I would say implementing systems that track those metrics that we just talked about, working with third party, maybe accounting firms or other third parties that are helping them clean that data for historical periods, and helping them implement these systems going forward, because historical trends are very important when evaluating any business. So having access to all that clean and reliable data is very important. I would say working with a legal team to focus on cleaning up all the legal documents. Typically, legal due diligence is kind of approached at the very end of a long, which can be tedious process. And so what you don't want to do, or you'd like to avoid, is at the 11th hour having to clean documents or collect signatures or whatever it may be. So having all that done in parallel would be very helpful. And then most importantly, though, I would say focusing on not only growing the business, but product differentiation. That's very important as well.
Yeah, great points. And I think the legal side doesn't get enough attention. And just, a part of the exit process, right? A lot of buyers will wait, they'll go through due diligence, and they don't want to, right, release the attorneys yet and have those big bills until later in the process, where they feel good, like, hey, we think, things look good, due diligence is good so far. But then they kind of release the attorneys to go in at the end, because that's going to cost them big bucks, versus in the beginning where it's like, oh, we uncovered this, let's just stop it. But then they had this big legal bill.
Right. 100%. Yep.
Yeah. So there's kind of a stage where it's like due diligence, and phases where it's like, because, right, it's costly, if the valuation is up there, there are definitely a lot of fees associated with purchase.
Right. They're not going to bring in the legal unless they're certain. Obviously, they're going to close the deal, so you'll be in diligence. Yeah. Most of the work has been done, and so you're so close to the finish line, and the last thing you want is have to go, cross some T's and dot some I's. So if you're able to do that ahead of going to market, then that would be very helpful.
Yeah, absolutely. For example, like that legal cleanup of like, oh my gosh, we need to have, employees to sign IP agreements or whatever that is. Yeah, you don't want to be scrambling at the end. So yeah, that's really interesting. So when does it make sense? I'll call this like we call this, like a process, right? We're going to exit. When does it make sense for a founder or founding team to run what I call like a formal exit process?
I mean, I would say always. A formal exit process can be, I mean, you can engage with a third party, with a M&A advisor, a banker, and you could run a broad process. And you could run a process where you're talking to a limited number of buyers and PE investors, or you could run a formal process and just one party. I would say all of these fall under the umbrella of a formal process, obviously, because you're engaging a third party. And the reason why I say always, because whether you're talking to one party or you're talking to 150 parties, you're going to have to clean up that MRR data. You're going to have to look at retention. You're going to have to slice and dice the analysis and the data. You're going to have to highlight the strengths of the business and position around the weaknesses of the business. You're doing that same work regardless of how many parties you're speaking with, but you also need to operate your business day to day and make sure that you're continuing to grow. And so that on its own is obviously a full-time job of multiple people, and the CEO or a founder is not, it's not efficient use of time, and it usually will take away from the day-to-day operations of the business, especially earlier on. With smaller businesses, I mean, the CEOs are typically wearing multiple hats already, operating the day-to-day aspect of the business. And so having that third party help out is very important. And that's why I would say always. And then the last thing is third parties or M&A advisors, typically, I mean, they would know, they do this for a living, right? We know the questions that we're going to get asked. We know what buyers are looking for. And so having that perspective and that guidance and coaching throughout the process, again, whether it's one party or however many, which would be very, very helpful for any seller to ideally maximize valuation.
Yeah, absolutely. Because in an exit process, the employees or the leaders, right? It's two jobs, right? Running the business, and then that process, which takes up a lot of time. And then maybe in the end, right, nothing happens, and maybe you've just given away 6 to 8 months of your time and not focusing on the business. So definitely intensive effort. So for founders, who may have exited multiple times, they understand, what M&A advisors do. But for those first-time founders out there, can you tell me a little bit about what role, or what services M&A advisors provide?
Yeah, so typically what we'll do is we'll be involved in the preparation phase where you're getting up to speed on the business, you're helping analyze and looking at all these metrics. You're finding angles that maybe, especially in the data, that maybe the operators of the business didn't necessarily know or aware of, just because that's not how that from their seat, that's not how they typically look at the business, right? And so trying to find those nuggets to kind of, outline and showcase when going to market for buyers. Also positioning around any weakness that, like I said, no business is a perfect business, and that's okay. So positioning around that, and also then having those active conversations with parties where necessarily the seller isn't necessarily involved, and they're focusing on their day-to-day business and operations, and then helping, qualify parties that actually the seller is spending time with, right? We're also helping with negotiating offers and building competitive tensions between parties involved in the process. And then ultimately supporting in due diligence, working with the legal third parties, accounting third parties, any tech third parties that are involved, and managing really the communication between all the sellers, third parties, the buyers, third parties, and ensuring as smooth as possible, finish to the race.
Yeah, absolutely. Just almost like a quarterback, right?
Yeah.
And then one thing I think super important, when looking at advisors, is you don't really realize when you get into it is just that relationship you develop. Because what kind of time frame do you see from kind of start to finish, and it probably, depends on company size, but what's that typical range as far as like, how long is an exit process going to run?
Yeah, I would say on average, a broad process typically run between 6 to 8 months. Obviously,
Hmm.
each process is different, and some take longer, some take shorter. But on average, I would say 6 to 8 months. And so you're absolutely right. You're dealing with us. You're dealing with those people every day,
Hmm.
almost, especially in the very beginning and then towards the very end. And so you're trusting them also to sell your business that you founded X number of years ago that you have an emotional attachment to. And so you're not just going to
Hmm.
go to somebody you don't get along with, right? You need to, so having that relationship is very important. And so I think when selecting an advisor is just knowing that, all right, I can see myself having casual conversation with this
Hmm.
person there. They kind of understand where I'm coming from or how I operate my business. That's very important.
Yeah, absolutely. I completely agree with that. Founders out there, it's like, yeah, that relationship is so important. It's like, hey, someone you want to work with every single day, that you're in communication every single day, or maybe you get to those management presentations if they come back in person again, where you spend a lot of time with these people. So it's important that it seems so basic that you like them, you want to work with them. So
Right.
often overlooked. So we'll end with a final question, and this one comes up a lot, tons, and it's really interesting, right? Because SaaS business models are changing, cloud business models are changing, pricing models are evolving, right? Where, hey, plain old subscription revenue, is kind of, an old version of the SaaS model almost. Now you're seeing usage, consumption, transaction, even, still hardware out there. So I'm curious, this comes up, the order of valuation, right? Are all revenue streams made the same in the world of valuation, or is, subscription still king, contracted revenue still king in the valuation world compared to usage, transaction, etc.?
You're absolutely right. You're starting to see a lot more usage or transactional revenue streams than you probably did 5 to 10 years ago. That being said, contracted subscription revenue is still king. And it kind of ties back to what we are talking about risk. And so when a customer is contracted for a year, however many months or years, and for an X dollars, that's less risky, right? Because they're contracted, and versus if it's variable based on usage or transactional, there's a lot more risk. And that kind of really showed last year when COVID hit. I mean, you saw businesses' revenues just tank. I mean, if you look at Eventbrite's Evitda Rev went from double digits to single overnight, and that's purely because there's no contracted revenue, right? There was no events going on, there was no ticketing, it just didn't make sense. And so looking at subscription revenue is still king, absolutely. That being said, though, what we're starting to see and what we like to see with a lot of some of the businesses we work with is that they'll have a base subscription that's contracted, but then they'll have also an additional usage or transactional revenue stream. It could
Mhm.
be as simple as payments, where they get a percentage of the payments that go through the system, or usage base or users, whatever it may be. And that way, that's nice because you kind of de-risk, because you have your subscription, and which would still be the bulk of the recurring revenue, right? But you have that reoccurring that kind of gives you an upsell that is very nice and obviously helps drive net retention. So we like to do that. We like to see that. And then, like I said, it'll be less risky than just simply having a transactional revenue stream. Because yeah, I mean, and nobody expected a global pandemic, and
Yeah.
it happened overnight, and you saw what happened. So it's nice to have that contracted revenue stream.
Yeah, so really interesting because, right, you see different business models. So it sounds like if your majority of your revenue is subscription, contracted subscription, and you had mentioned this before, almost seen as like collateral, right? Contracted
Yeah.
collateral, it's in place, we can rely on it. So it sounds like if most of your revenue is subscription, plus if you have usage transaction on top of that, very attractive because you have that expansion potential, the good net dollar retention potential.
Mhm.
But if it's the other way, if say just 20% of your revenues are subscription, and let's just say 80% usage, it sounds like maybe, are we looking at maybe a little discounted valuation, because of the makeup of your revenue stream or
Yeah.
overall revenue stream?
Right. No, yeah, you definitely would, because if you think about it, if the vast majority of the ARR, or the recurring revenue is subscription, and then you're just getting a little bit of usage on top of it, if that usage goes away, net retention will probably, and gross retention will probably be dinged a little bit, but your lost ARR will still be the same, because that's not, you didn't lose that customer, you just, instead of that customer paying you $100, now they're paying you 80. Versus if it was the inverse, then you're losing that $80, right? You're losing that majority of it, and that contraction ARR is larger, and so your net retention or gross retention would be hit a lot more if the contracted ARR or contracted revenue was the lesser percentage of the split.
Yeah, makes sense. And then what about, say, are you seeing more payment processing or companies taking a percent of payment? Like, so we have subscriptions and then we have some sort of transaction feature. And even I've talked to companies where they have payments going through their system yet, where they facilitate the payment, but they're not actually taking a percent of it yet, or they plan to. So do you see like payments, taking a percent of payments as being more common now?
Yeah, it's more common now than it ever was. And then we are starting to see more companies start to think that way. And so where they're like, wait, we've been doing this, like might as well, monetize off of it. And that's an opportunity that can be seen as a low-hanging fruit opportunity for a lot of businesses. And that's attractive, especially for private equity firms, if they're able to know, with little work and just generate more dollars, even if it's transactional. In this case, it's not. It's a small percentage. Why not? The pro of it definitely outweighs the con.
Yeah, makes sense. So that was it. That was my last question. I mean, this was great. Of course, valuations can be a tricky topic. So I help the founders out in the audience, the finance teams, provides a little bit of guidance, about how to think about valuations. We talked about, metrics to look at, right? Growth, revenue retention, EBITDA profitability, et cetera, how to get your house in order, so really good stuff for those founders who are thinking about exit or just thinking about valuation. What do I need to do? What metrics do I need to look at? And how does this process work? So Karam, really appreciate your time today and the answers to these questions. It was fantastic.
Yeah, absolutely. I'm glad I was able to help. And yeah, Ben, thank you very much for this opportunity. This conversation was great.
All right. Thanks a lot. Take care, everybody.
Thank you.